Well, my name is Athriya Chaganti, and I have my colleague here, Simon. So we're going to tag team here a little bit. We work for a company called CMC Partners. CMC Partners, very quickly, and I'll keep this short so that we can move on to the fun and interesting part of the conversation. We've been in business for about 30 years now. We primarily work with small and medium enterprise companies, so SME businesses, help them with a range of services. But they broadly fall into helping them with the growth strategies, so figuring out ways by which we can deliver exceptional growth into the businesses. These are typically founder-led, privately owned businesses that are looking for creating exceptional value to their businesses. They are usually the clients that we like to work most with. We also help them with selling their businesses. So we had a session a couple of hours ago today, which was all about how do we help business owners realize maximum value for the business that they have built across the last 10, 20 years of their own life. And we also help acquire businesses, and that's what this session is about. So we're going to talk a lot more about why do companies acquire, what's the benefit of acquisitions as part of their growth strategy, and how exactly do we go about acquiring companies. So what's the process behind the acquisitions themselves. Very briefly, my name is Athriya Chaganti, and I have spent, unfortunately, a considerable amount of time in corporate M&A, corporate strategy, and I've worked with various companies across the telecom, media, tech sectors. I also own my own healthcare tech venture. I've been in the advisory business across various functions, strategically across sales, marketing. I do a lot of business performance enhancement work, which is all to do with increasing value of businesses, especially when they are underperforming businesses. How do we get them back onto a growth track and make them competitive so that the enterprise value of companies increase? Simon here, my colleague, he's been with the company a little bit longer than I have, but he comes with considerably larger amount of experience, if I can say that, Simon. And he's been also involved with his own business that he has successfully sold with corporate background. Right. So let's start off with a couple of numbers. And I think this will hopefully set the context of what we are trying to talk about. So private company acquisitions, or data about companies that have been bought and sold within the private business sector, is notoriously hard to get for the obvious reason that it's not published. There is no obligation as part of public shareholder disclosure to make any of the transaction information available. But if you look at some private company databases, and this one has been taken from BVD, Bureau van Dijk, we extracted information for the last 5 years on private company transactions in the deal value between £1 million to £20 million. So that's primarily enterprise value between £1 to £20 million. That's broadly the range that is classified as the broader SME segment. Although SME sector has got wide definitions across industries, it can range anywhere up to $250 million. But in terms of the volume of interest, if you may, this shows the graph and the progression in that sector range. The number of deals on the top you see were about 308, which has now doubled in the last 5 years. The total value of these deals in the same period, so that's 2014 to 2018, we went from about £2 billion to just under £4 billion. And if you look at the average deal size, which is basically the total enterprise value divided by the number of deals, you see an average deal size of somewhere between £6.8 million, dropping roughly to about £5.8 million. So what does all this show? Well, a couple of things. One, on average, this is about 2 transactions per day that are going on in the UK market. That might not seem like a lot, but I think it's a considerable amount of volume, especially given the size of the market. And the second is really the average deal sizes. So deal sizes have fallen approximately 6.8 to 5.7 or 5.8, so that's about a 15 to 18% drop. And that's also interesting to know, because as deal sizes fall, it usually is an indication of a couple of things. One, the number of deals in the market are increasing. So that means there is a limited amount of money that people are putting into the market to buy, but there are a lot more acquirers, and hence there's a pressure on the sale price. The value of the deal has fallen. And second, it could also be reflective because this picture is not across sectors. It could be a reflective, or it could be a reflection, of some sectoral differences where a larger number of companies are coming into the market in one given sector, putting pressure on the selling price. But either which way, whatever is the underlying sectoral difference that this picture kind of masks, I think the point is that there is considerable volume in the size of the market that we are going to talk about, which is the small and medium enterprise segment. So, as I said, I've been doing this for over 2 decades now, and I cannot recall even one instance where a company that is looking to acquire another business has primarily come to that conclusion for the first time without doing any other strategic investigation, which basically means that M&A as a mechanism for growing is usually never your first point of call. So how do companies grow? Well, as this picture says, usually there are organic levers of growing that we are all aware of in businesses. So let me just put a context to this. So I differentiate organic, or rather I define organic as something that is innate to the business. So nobody external to your business has contributed to that growth. And this picture basically separates two sources or two forms of organic growth. Those are tangible elements, so your customers, for example. So your customers are always your primary mechanism for generating growth. And incidentally, by growth, here I mean elements such as revenue. So we all know what revenue is. Another growth element is usually profitability. There are various metrics for understanding what growth of profitability is. So EBITDA, for example, is a normal measure. That's earnings before interest, taxes, depreciation, and amortization. EBIT, which is usually a proxy for operating margins, that could be another measure of profitability, and of course net income. So irrespective of what measures you use, growth of the business usually translates into growth of revenue or growth of margins. You could be a little bit more pedantic, you could be a little bit more stringent, and you could talk about things like return on invested capital or return on assets. Those are additional measures that you can measure, that you can use to measure the growth of the business. But all these essentially are reflections of how the business is performing. So customers and the quality, the nature, and the growth in customers is usually a very strong reflector, a good indicator of how well the business is performing. Similarly, products and services. So what you're providing to the customers is equally important as anything else. So as the number of services that you're providing to customers increases, obviously you expect to have a much higher level of organic growth. Marketing and sales, which is usually your ability to convince customers of the value proposition and hence more customers willing to buy, that also is usually a strong reflector of how well your organic growth performs. And then you have things like R&D, your patents, and of course your customer experience. All these elements that you see on this picture in red are, to me, tangible elements of organic growth. And every company, before you reach the decision point that you should acquire, should actually look internally to identify and see if your organic growth measures are performing up to the expectation. Similarly, you have a lot of intangible elements of growth, and those are in blue. So things like your business model, your brand, these are intangible elements that reflect growth. So the primary purpose of this picture is, before you think about M&A, we always recommend, as business advisors, as strategic advisors to our clients, understand how well your organic business is performing, because this is super critical to making acquisitory growth or M&A-led growth work. And let me take a couple of more slides to really explain my point here. So this is a picture that we normally use in terms of talking to our clients about what we call a strategic audit. So a strategic audit is to look at your business with a very fine-grained tooth and comb to be able to say how well is the business performing at various elements which contribute to the growth of the company. So, for example, we spoke about customers and products. So, do you have customers on whom you're predominantly dependent upon? That means you have a very high level of customer concentration risk. Do you have customers who actually buy only a few of the products or services that you provide? That probably means that your existing customers are buying products and services from some other competitors of yours because they're not buying all the products and services that you provide. What about customer experience? Does your client or your business, your customers, do they speak very highly about your own business? So is customer experience, for example, a strength of your business? This strategic audit essentially is a deep dive investigation of what your strengths are and what your weaknesses are where you don't tend to perform very well. And the gap between what your strengths are and where you want to go, your aspirations, are usually strong candidates for acquisition. So it's a structured way of thinking to say, why do I want to acquire? Because I'm good at certain things, but I'm not very good at providing superior customer experience, although I have a world-class product, which probably means that identifying a mechanism for customer support is a good point for you to acquire an external capability. So think of this as really a template by which you come to the logical conclusion as to what are those elements that you should actually be acquiring that in turn will contribute to growth of the company. So this picture demonstrates both statistically as well as from our own experience at CMC and in the past, 5 predominant reasons why an SME business might want to look at acquiring another business. So let's go through this because this is actually a segue for us to really look at the motivations that small and medium enterprises have in acquiring other businesses. Invariably, the very first reason why companies end up acquiring another business is to gain access to new customers. So you have your organic growth, which we spoke about in the last couple of slides, but typically the organic growth process, as a result of that strategic audit we discussed earlier, will get you to a certain level. So as an example, a client of ours that I was involved in for a long amount of time as part of the strategic advisory process, they spent about 15 years in the market, and they managed to, it's a European business, it's a telecom software business, and they essentially spent about 15 years of their existence, and they managed to achieve a growth rate which gave them about 12 customers, of whom 8 of those customers was in one country. So there was an organic maximum, if you may, that this organization, our client of ours, reached, which essentially said that if they have to grow beyond those 8 customers, they essentially have to look at alternative means, and acquisition was one of the reasons, was one of the mechanisms by which we felt that we could come out of that growth trap. So gaining access to new customers is normally a good reason, once you've gone through the strategic audit process, to say, if I acquire a business, I can actually get another 15 customers in. Similarly, distribution channels. So assume you are a product manufacturer and you are in a manufacturing business, so you're manufacturing widgets, and you're very, very good at the manufacturing process, but you're not very good at taking the product out into the end customer's hands. So looking for distribution channels which take an existing product out could be a complementary fit. So this is very, very common when customers who want to focus on one or the other part of the value chain end up saying, hey, I'm very, very good at software development. I'm very good at, for example, looking at a certain piece of a service, but I don't necessarily know how to put it into the hands of customers. So let's look for corporations or organizations that can give me access to those customers, and hence a distribution channel becomes an important reason to acquire. Technology or IP acquisition is a very common reason to acquire. So you already have a piece of technology that you want to supplement. We've gone through all of us are aware of the enormous amount of changes in the tech industry in terms of cloud services that we have seen. So various traditional providers have acquired cloud businesses. Similarly, a lot of digital and creative agencies that have now expanded because their clients want them to, have moved into software development, for example. So this is acquisition of technology, acquisition of capability that complements what you yourself are doing as part of your core business. A lot of companies acquire other businesses because it gives them faster access to new markets, new territories, new geographies. So let's say you are a business in England and you want to expand into Scotland, into Wales, or maybe more ambitiously into another country across the pond. You might want to go to the US, or perhaps you want to go into continental Europe. Of course, you can do it organically, but that takes time, it takes money. But if you really want to get a jump start, you could look at a business that's complementary to yours, and you could say, okay, let me go ahead and acquire this business that has well-established presence, perhaps in France, or maybe in Scotland, where you want to gain access to that territory. Generating scale economies as a reason for acquisition is also quite common, and all that simply means is, I am, for example, in the services business, so I provide human resources like IT services. So I essentially look at providing a human-centric service to my customers. In order for me to scale that business, so I have 100 people, I can scale the business only when I acquire more people because it's a people-dependent revenue business. So one reason for you to acquire, if you are in that business, another company, is I can now combine my 100 people with another 100 people that I've acquired, and these 200 people can deliver similar set of services to a larger number of clients for less cost. So you primarily create scale economies where the cost of delivering to the same customer is marginally lower than before the acquisition. That's another strong reason for acquiring companies. And finally, a lot of companies acquire in the life cycle of that industry where a certain level of maturity has been achieved. So when there are lots of companies providing similar sets of products and services, it's usually a reflection of both the maturity of the market, but also excess capacity in the market. So telecom is a good industry to talk about, where you will find a range of small and medium enterprise companies that are doing highly similar things. So for example, communication technologies, collaboration technologies, software and development services. So these are segments which are relatively undifferentiated. A good example really is, we are in this event, walk around, and if you find 2 or 3 companies that are displaying and exhibiting similar looking products and services, it's usually an indicator of where there might be progressively excess capacity identified, because no one company differentiates itself very well from the other. So in that kind of a market scenario, acquiring your competitors can be a strong rationale, because that gives you scale, that gives you size, it gives you access to customers. So what we normally tend to advise our clients is, when you are evaluating the reasons for acquiring another business, look for a combination of these businesses. And if rationally, if through a structured thinking process, you are able to say, yes, I want to acquire new customers, I want to go into a new territory, and I want to be able to build scale in the business, these are a set of reinforcing reasons that are usually much better, and they will stand in good stead for you to make that acquisition successful. So in other words, have a very strong business rationale for acquiring. So that's the business rationale part of it, but acquiring businesses is all about managing the financial rationale. And I think that's really super critical, especially to make the final deal successful. And we'll talk a lot about what it takes to make a deal successful in this presentation. So this is a fairly elaborate and a lengthy piece of conversation that we can have. I've attempted to simplify this a little bit for the purpose of this presentation, but the summary of this really is when you put money into anything, it doesn't have to be acquiring a company. It could be any strategic decision you're making in your business. It could be to create a sales organization. You might be hiring a sales manager, for example. Or if you are growing operationally, you want to be able to create a structure, you might want to bring in an operations manager. You might say, I have now enough number of people in my organization, so let me bring in some HR practices, and you hire a skilled HR manager. So professional manager investment requires money. Similarly, let's say you are in a manufacturing organization and you want to invest in new machinery because you want to expand capacity. Whatever is the reason for you investing money in the business, putting money into acquisitions is fundamentally no different from putting money into any other piece of the business because it's ultimately an investment. So which basically means that for us as advisors, we always tell our clients, our businesses, the business owners to whom we provide services, to look at putting money into acquisition as fundamentally an investment decision. So it's a capital allocation decision. So you take money and you put it into acquiring a business as opposed to taking the same money and putting into buying machinery, for example. So the discipline that you have to go through in making that decision is fundamental to making that decision successful. So how do we do that? Well, we do that by basically answering these three questions as critically and as diligently as possible. So when you acquire a business, your first question really should be, if I acquire this business, would I, as an acquirer, as a shareholder, as the business owner, am I going to be better off from a shareholder value standpoint than I was before I made the decision to acquire the business, right? So that's a shareholder value-based question that needs an answer. Second, can I acquire this business or this asset? If you're not buying the whole business, you can buy a piece of the business, which is usually an asset acquisition. So can I buy whatever I'm buying from this company at $1 or a pound price, which is lower than it is worth? Right? So think about it. So I'm basically saying, I want to acquire this business, it's worth £1 million, but can I pay £900,000 for it? Or can I pay £850,000 for it? So that's basically a mechanism by which you are forcing yourself not to pay £1 million and £100,000 on top. So you don't want to pay £1.2 million for it. For a business that's worth £1 million, you ideally want to pay £850,000. So force yourself to say, can I do a value-based acquisition, right? And the third one, which is often a bandied term, but I think the S word really here is synergies, right? So for some of you, if you have attended the talk that Simon and I gave a couple of hours ago, we basically spoke about synergies from the perspective of the seller, which is if you are putting your business up for sale, you need to be mindful about how the buyer on the other side evaluates the reason for the acquisition. It's exactly the same when you are trying to acquire another company into your business. What are the synergies that I gain as a result of that acquisition? And we'll speak a little bit more about synergies because that's both from a business rationale and financial valuation standpoint quite fundamental. So what are synergies? Well, very simply, it just means that if I put two pieces of businesses together, it should be more valuable than those individual businesses summed up together. So that's represented in that green piece on the top part of this chart. And as you can see, the value of the company that you're buying, which is the first bar on the left, the blue part, is the intrinsic value of the business. You add synergies, which in many ways you can think of it as a quantification exercise of the benefits of buying a company. And the sum of those two bars should really be arithmetically and logically the maximum value that you should pay for the business. In other words, if the price that you're paying is larger than the red bar that you see, you have basically overpaid for the business, right? So this is yet again another way of thinking about valuing the business that you're intending to acquire. So in practice, how do synergies get created? Well, there are lots and lots of sources of synergies, and usually your business advisors, and we do this all the time, they will help you identify in the business the sources of synergy that you're acquiring so that you can appropriately incorporate that into the valuation process. So let me give you a few examples, and I've broken them up into 3 buckets. So the first one is revenue synergies. Revenue synergies are usually the most tempting to apply, but usually the hardest to bank or the hardest to realize. So an example of a revenue synergy is, let's say you are a software manufacturer, and you are in the business of creating software products, but you don't necessarily have a very strong mechanism of providing support, customer support for service for your customers. So if you are looking to acquire a business that is very strong in services, and you combine that with your product portfolio, you suddenly have access to customers to whom you can sell your products because you have bought a company that is very service oriented. And similarly, the company that has sold itself to you, so the target company, will have an opportunity to sell their services to your customers. So basically, you have brought 2 companies together with different set of customers who can then buy from each other. So that's a source of revenue synergies. Another example would be, let's say you are, so a company that we've been working and representing recently, so you are, let's say, in the business of installing pipelines for oil generation. So basically this is a company that supports installation of pipelines. See, these are oil pipelines that carry oil, basically, crude oil. And this company is now looking for capabilities, so acquiring companies that bring the capabilities to service these pipelines. Now, what that essentially means is this company will suddenly have access after the acquisition to a string of customers to whom they can provide their installation services, while the company that has been acquired will have access to the parent company's customers to provide post-installation services, right? So this is a mechanism by which you can co-create new sources of revenue that you don't have access to earlier. And that has a very strong, tangible pound value that goes into the synergy quantification process. Another example or another source of synergies, which is usually a significant part of the synergy quantification process, is known as cost synergies. So cost synergies very simply are, I acquire a business, and this business has a lot of back office, so they have IT support, they have legal services, perhaps they have 1 or 2 people in the HR team, and I have the same, right? So I have some IT services, I have maybe 1 HR manager, maybe I have a couple of salespeople, and I feel that I don't need all the back office, I don't need all the IT, perhaps I don't need the HR manager in the company that I'm acquiring. So by reducing redundant operations, you basically save costs, and that's a significant source of synergies when you acquire a new business. Finally, capital synergies. So as SME businesses, as small and medium businesses, you have a lot of challenges in, for example, raising money, because banks usually don't lend to SME businesses as well as they do to larger companies because of the risk profile, the nature of the business. When you combine 2 small SME businesses, they become larger and they become more attractive to potential lenders, because now the risk of lending to a slightly larger business with better cash flows is lower than having lent to the smaller businesses when they were individual businesses. So this is an example of capital synergies. Another example would be your procurement services. So your suppliers, you can negotiate better terms and conditions with your suppliers when you're slightly larger than being a very small business with whom you don't have any negotiating leverage. So irrespective of what the sources of synergies are, it's quite vital that you work with your business advisors in this transaction to say, where do I benefit across these buckets so that I can put some kind of a pound value, some kind of a monetary monetization aspect to the synergies, because then I know that it's worth paying for this transaction. So with that, I'm going to hand it over to my colleague Simon, who is going to now help us walk through how exactly do we do this.
Thanks, Atreya. Okay, so Atreya has talked about the strategic background to why you might want to buy a business. The kind of shorthand version is 2 and 2 and getting 5. You have to create value. And that value is delivered by synergies, and it's what drives a deal. That has to be a rationale. So I'm going to talk, as Atreya says, a little bit about the practicality. How do you get a deal done? What are the broad steps you have to go through to make it actually happen? So this has picked out the kind of 3 building blocks. There's the planning phase, really all the way through to the rough agreement with a target. There's then getting the deal done, which is very much a legal process. And then there's the final, and I'd argue the most important phase, which is the integration. Let me just say one thing. This is a little bit misleading. You should be thinking about integration when you're planning, because that's how you test all of your hypotheses as to why it's a good thing to do. I've done a number of acquisitions through my checkered career, and the ones that have gone well was when we had the clarity of strategy, but also we'd really thought through what was going to happen the day after we bought the business. Because without that, you can get deal fever, you can do the wrong deal very, very easily. So this is that first phase, and I think Atreya has really talked about the stuff on the left-hand side is having a clear strategy. Why are you buying this? In a former life, I ran a network business and we bought a software company, which was a little strange, but the rationale was very strong that we needed to buy in this key supplier to my bigger business. So we were very clear about what we wanted from the deal. We understood them very well. We'd done all our research. So we did do, I think, a successful transaction because we had thought ahead about how it's going to work. If you're having to go to a search, goodness, when I started doing this years ago, you could identify your strategic rationale. You could say, I want a business that does X, Y, Z. Finding it was a bit of a nuisance. Now Google means you can decide you need a particular type of business and Google will tell you the answer. Or rather, he'll give you a short list. So through that process, you identify who your targets are. You've decided the sort of industry you want. You've sorted the size you want. You've talked about the location. So you build in that first block a very clear picture of what you want to buy. And I say now it's very much easier. There's so much knowledge out there, and you will have to kiss a lot of frogs, but you're able to find the sort of company that fits the bill. You then start to engage. You then start to have the conversation, and that's a bit of a dance around the handbags, as you might expect. Some people are for sale, so that's kind of easy, although not, because it's competitive. I bought an IT business once, and it was the first time they'd even thought about selling was when I popped up and said, we think you'd fit as part of this larger organization. So you can get your targets either from the businessforsale.com website, or you can target yourself. You can work out who you want, and you can use an intermediary to get on the phone and say, somebody might want to buy you. Do you want to talk? Perhaps something slightly subtler than that, but that's what it boils down to. Then you're engaging. Then you're having a conversation about how it would work, a little of a wooing process, but then you start to talk numbers. And through that effect, you end up agreeing a price. And that produces, some people call it a term sheet, heads of agreement. It's basically a written version of the handshake. I will pay X million, here are the terms, here's perhaps what you want to do, Mr. Director, when we want you to stay with the business. So it lays out, in that sort of context, the structure of the deal. So that's a process that could take, depending how long you research, that's sort of easy bit time-wise. You've got your strategy, that's hard, but the rest is kind of you're off to the races, and then you work out how long. So that can take 2 months to 6 months, but you're in control of that one as a buyer. So then the next stage is getting the deal done. You've got a deal in principle, but no more than that. So you're then into the first stage of due diligence. Here you're looking for proof that what you were told was true. It shouldn't be about discovery. It shouldn't be about understanding what the business really does, because you need to have that before, because here you're paying money for lawyers and accountants. So in this due diligence phase, you're checking that you've been told the right thing. That, goodness, can go on from a month to a year. This is when you really get your head under the bonnet of the business. As a seller, if you're a seller, then prep this stage. It's boring, some of it. There's a lot of paper. There's a lot of digital paper. There's lots of contracts and documents and all that sort of stuff. So have it ready for your buyer, because when the buyer comes in, that's what he's going to want to see. The legal process is driven by the lawyers, as you'd expect. They can often run in parallel, so you can having due diligence going on the one hand, and then you'll have the lawyers working on the sale and purchase agreement. As a buyer, you're wanting to de-risk it, so you've agreed a price. Your due diligence is all about reducing the price, finding out what's wrong with it. You don't do due diligence to find out it was a better business you thought, and then you can pay more. It doesn't work that way. It's completely the opposite way. So you're running that process alongside the legal. Big issue with the legals is always making sure you're trying to de-risk it. And in practice, that's done through things called warranties. So you want assurances from the buyer that there's nothing horrible in there. So that phase is, again, quite time-consuming. Lawyers, you're burning quite a lot of money now. Lawyers' fees for acquisitions, are in the tens of thousands up to anything more. So it's a big deal. And then the close, well, that's the sort of conclusion of all those bits. In my experience, the larger the deal, the more chance it has of closing at 3 o'clock in the morning, because lawyers love that. It's all part of the game. You're finalising the documents and trying to get everything done. And a lot of deals, when you do that, the cash change. I've been sitting in a lawyer's office at 3 o'clock in the morning. We've completed, we've signed, and we're waiting for the money to appear or to leave our bank account into someone else's. So it's quite a sort of bizarrely fun activity if that's what you enjoy. So it's a process. It's a machine. It's very dominated by advisors. If you're skilled at buying businesses, by all means do this yourself. If you're not, get help. You'll certainly have a lawyer involved. You'll certainly have either your own accountant or a very well qualified accountant to do all this modelling to make sure what you think you're buying, you are actually buying. So the integration phase. Integration is actually, it is the word that's used. It's slightly the wrong word. Broadly, two types of integration. Either you say to the business you're buying, you say, right, I'm going to leave you as you are and let you get on with it. We'll put some control mechanisms about it. Basically, you just keep doing what you're doing. Now, that's not a very good way to do it, I would argue, because remember, you want 2 and 2 and get 1. You don't want 2 and 2 and 2 and 2 and you want 5. You don't want 4. So leaving them alone is not necessarily the right thing. So what you need to be thinking about is, and as I say, not when you bought it, because you bought it at 3 o'clock in the morning, you have to think this through from the very beginning of the process as to what you're going to do with the business. So let me give you a couple of examples where I've seen it work and not. Salesmen. Salesmen are rare and precious flowers, as you would understand. Hope there's not too many salesmen in the room. But they're the sharp end of the business. So when you're integrating a business, you have 2 sales forces. And I've certainly not got this right on one occasion where the egos, because you're pulling these 2 businesses together with integration plan, these 2 sales forces are going to charge out into the market with their combined capability of the new business. Well, it doesn't always work that way. So getting the sales guys clear about their go-to-market strategy, how they're going to approach customers, who their customers are going to be. And really it's that level of detail, because that starts on like day 1. The sales guy says, right, what do I say now? I've just been bought, what do I say to my customer? So you've got to have that really under control. You've got to have the sales guys lined up. You can't tell them much before the deal's done. That's the other problem, because it's a secret. Last person you want to tell is the sales guy, because you can tell the world. So suddenly you tip up to the sales team and say, guess what, we've just bought a company. So I did this, closed the deal at 3 o'clock in the morning. 6 o'clock, must be 9 o'clock the next morning, standing in front of the guy saying, here, the merged business. Here's how it's going to be. So getting that right is uber important. The other place where it can go a bit tricky is systems. Very different systems, often between businesses. You may say, you may both be on stage, but they're never the same. If you're slightly bigger, you'll have a bigger system where there'll be no integration. So understanding how those systems work together is really, really important. The truth is, a lot of acquisitions fail, and I would argue this is where they fail. They haven't really thought through how it's going to work, because they've got to generate these synergies, because that's what they're depending on. They've just taken a guy and given him a wheelbarrow full of money, so he is staying with the business, but he may not be entirely focused. So getting this integration planning, however you're going to do it, really correct, for me, is the kind of nub to all this. And thinking that through, because you will have strategists, you'll have your marketing guy saying, if we combine these two elements of our business and the new business, everything will be fabulous. And at the strategic slideware level, that may be true. You've got to test it with an integration plan that says how it's going to work. So just sort of starting to summarize where we've got to with this. Strategic rationale. You've got to have a good reason. And believe me, certainly corporates can get into this out of vanity, for all the wrong reasons. This isn't as blindingly obvious as you think. A fully worked out strategic rationale. The value point is that you can generate synergies. Just buying a business to make you bigger doesn't help. The value is all about bottom line and cash. So if you haven't got a proper reason, then it'll fail. The synergies are credible. Again, that's that practicalities test. You have to move from the theoretical to the practical. It's expensive. So certainly in the public company arena, a lot of public companies have cheap capital, rush out and buy a business, and end up finding they bought a turkey. And the impact that has on their ability to expand the business is really, really inhibited, because they've used their money buying business that hasn't worked out. Hewlett Packard bought a data business, and it really did screw them up. So much money was spent on billions of dollars was spent on a business, and the rest of the business has suffered simply because of that. So right at the top end of the scale, all the way through, you don't want to get it wrong. So this is the sort of how to get it wrong slide. Opportunities, you hear someone's for sale, that'll fit, let's go and buy it, and then you're working backwards to justify why you should buy it. Not a good idea usually. If you're trying to build a strategy around something that you thought was a great idea before you thought about it. Same goes with glamorous acquisitions. If you're buying a bigger name, if you're buying something with a stronger brand name, super, but it has got to be able to deliver value. So that's always the test. Incredible synergies. Certainly when I was in a corporate job then, that was the place we spent most time. Really? Is that synergy really going to happen? And you've got to be clear, and you've got to push that one, because that is where the value comes or not. Okay. So that's kind of the overall picture, that acquisitions is a great way of growing the business. It's a great way of bringing in credibility, bringing in customers, bringing in capability. But unless you get that strategic rationale right from the front, it ain't going to fly. It's a capital acquisition process, a capital choice, if you like, to decide where you're going to spend your money, because this is the most expensive thing most businesses buy. So making sure it fits is a big deal. Don't have sort of acquisition fever that means you end up finding a business that you really like. You then have to go back to the rationale, rebuild it to suit the business you want to buy, and it just destroys the whole validity of the thing. So vanity purchases are definitely the wrong idea. Get professional help. I think on both sides, whether you're selling or buying, I would say this, wouldn't I? But get, if not our help, somebody's help to support you through this. Unless you have a big acquisition factory in your business, then you really need to get support from professionals who do this on a day-by-day basis. It'll keep you grounded, and ultimately it's making sure you get the right deal for you.